And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody might find this of interest, why don't you go ahead and share it with them as well? So, you want to outperform the stock market. It's easy, you think, right? Everybody just talks about it. I'll buy shares of NVIDIA and I'll just rock and roll forever. So, there's some new research out about how many stocks actually outperform the stock market. Ben Carlson over at Ritholtz, who I've quoted once or twice, says like this. He goes, a reader asks, could you talk about what percentage of stocks that are beating the S&P 500 over the last 5 years also beat it the 5 years before that? I'm curious what names appear in both lists with factors like pre and post COVID and pre and post AI playing a factor. Maybe you could also talk about how stocks beat the S&P over a 5 year window tend to fare over the next 5 years on average. Interesting question. So before I get to his answer, so you should know there's a lot of data out there. And I've spoken about it before that like 96% of stocks over time perform as well as your money market account, like short-term bonds. They don't perform well, right? It's a handful of stocks. It's a small percentage of stocks which bring most of the market gains. Okay, so keep that in mind. He answers, that's a great question because so many investors are concerned about the current concentration in the S&P 500, right? You know, the seven stocks, the eight stocks which are like pulling and over the last couple of years have just pulled the broader market forward. It sure feels like it should be a small number of stocks that have performed. In the 5 year period from 2016 to 2020, right, pre-COVID, the S&P was up a little more than 100%. From 2021 through this week, a couple of weeks ago, right, the S&P 500 is now up 90% in total. Those are both great returns at around 14 to 15% annually. So how many stocks outperformed in these during these different 5 year windows, you may ask? The number was higher than I thought it would be. There is a caveat here that stocks have moved in and out of the index over this period. The turnover isn't that high in the S&P 500, but it's probably 2 to 4% on average per year. According to his calculations, 149 stocks outperformed the index in the 5 years ending in 2020. That's pre-COVID. That's around a third, 30% of the total, which is pretty low, right? That means that over right, the rest of the stocks, 70% did not perform particularly well. In the last 5 years, the numbers are a little bit better. 241 stocks outperformed the S&P 500's return. That's like, basically a little bit under 50%. How many of them outperformed for both periods? 40 stocks. Okay. Not so good when you're talking about 500. What percentage is that? 8%. Right? Not so good. A lot of names Microsoft, Google, NVIDIA, Walmart, JP Morgan, Costco, and Broadcom were amongst those winners. Some surprising names outperformed in each of the 5 year period as well. Hilton, Caterpillar, to name a few. The stock market, he writes, is getting more and more concentrated at the top, but the number of stocks that outperform the index each year is probably higher than you think. Here's a look at the number of stocks that have outperformed the index in each year going back to 1990. I'm going to skip over that, but he says it's about 50% a year. A lot, which really interesting, is that I'm not so sure that that's true, and he actually speaks to that later on when he talks about actual mutual funds, actively managed mutual funds, and how disastrous they are in terms of outperformance. He says around 2% of all large cap funds were able to remain in the top half of returns for their category in 5 straight years. Right? What's that mean? That's not so good, right? In fact, percentage of U.S. equity funds that outperform their benchmarks over a long-term period, right? Over 10 years, it's nearly 90%. Over 5 years, 85%. Once you get longer term, 15 years, 20 years, it's like 94%. So even over a 3 year period, 87% of funds don't outperform their benchmarks. Okay. And they're the professional stock pickers. So, good chance you're not going to even do nearly as well as that. And outperforming is like, that's just, underperforming is like everybody. And then the rest of them sort of did okay. Outperforming is like almost impossible. So, why do I bring this, right? What's important about this? I think what's important is, once again, we have more data that shows us that it might be fun to trade individual stocks, but you're probably not going to be overly successful doing so, right? If you pick the right five, then congrats, right? You're going to do great. You're going to, grow your wealth significantly. But if you don't, you're going to significantly underperform the market. And you're going to spend a lot of time trying to do that, right? So you waste a lot of time, and at the end of the day, you don't make much money. That's not where we want to be on the graph. That's not the equilibrium. That's not the best point, right? Ultimately, you probably want to spend little time doing it and watching your money grow reasonably. I don't know what the best is. I don't know, underperforming, outperforming. You want to do okay. Okay. And, that's, we just linked to one index. We were just talking about the S&P 500, which is not, as you know, what I believe, at least, not the be all and end all to investing. There are plenty of other ways to invest. So what you end up wanting to do is have what I refer to as a reasonable return. Okay. Doesn't have to be the S&P. There are years. I know we've been spoiled over the last couple of years, but over time, the S&P 500 isn't necessarily the best performing index out there. Okay. So to link yourself to it, it's fine. Okay. But it's not the best. It's not the, I don't believe there is a best. There is no best way to invest, which is very important because people don't believe that. All the time, people will call me, well, what do you think about this? Well, give me a stock. Where should I put my money? I've got this amount of money. I want one stock. I don't know. How do I know? I don't have a magic crystal ball. And like I said, I don't believe there is a best investment. I think if you do okay, reasonably well, then you're doing reasonably well, which is what we can, we can all hang our hat on that. That's good. If markets over time, broader markets go up and up and up, and you're losing money every year, that's not so good. Okay, but if you're doing okay, that's fine. I think that's where you want to be. Obviously, you want your investments at the end of the day, and this is where people I think fall, is that especially now when markets are going higher and they're near record highs, and you have euphoria and AI and crypto and blah 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 blah. People think it's easy to make money, and they think that it's easy to pick stocks because I just put all my money into whatever NVIDIA, Palantir, whatever it is, and I made tons and tons of money. The problem is that these things all generally tend to revert back to the mean. Okay, which means that you might have made some money now, but there's a good chance if you stay this course that you're going to end up giving a lot of it back. For the few of you out there who are not, kudos, right? I tip my hat to you. You're doing great. But for most of you who are watching or listening, it probably behooves you, okay, unless you're really, really interested in researching and buying and selling stocks, then I would say, carve out a part of your portfolio, which is not a lot, to do so. But for the lion's share of your money, link yourself to broad-based indices and just let it rip. And of course, that's in conjunction with your risk profile, right? You have to understand what are you doing? Why are you investing? What is the point of your investment, right? If it's to generate income and not take much risk, then don't stick your money in the stock market. Buy a CD that's government insured, buy bonds, whatever it is, right? So that you sort of get a guaranteed fixed income. You have no business, right? If you're retired and you have a modest amount of money which you desperately can't afford to lose, you probably should not be investing in the stock market. Okay, that might go counter to what people tell you, but it's probably a really good idea not to do so because you can't afford to potentially lose 40 or 50% of your money, which can happen, right? We get spoiled, but it was only a couple of months ago. Right? It seems like 20 years ago. It was like 7 months ago, 8 months ago. The market dropped 20%. Okay, the recovery is pretty quick, but markets can get very, very, very volatile, and they can get violent, and they can lose significant amounts of money very, very quickly. And if you're not able to withstand that roller coaster, you have no business being in the market. So that's even the most important thing. If you're about trying to outperform, make sure that your investments are in line with what you're trying to accomplish and where you're holding in life, what your goals are, what your needs are. That's step number one. Filling in how to invest, that's step number two. That's sort of just like filling in the pie. But beforehand, you have to know what's the why. Why are you investing? What are your goals? What are your needs? Okay. You've been tuning into the Aaron Katzman Show. We speak about your life, your money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody may benefit for this, believe it or not, there is a share button which you can click on and share it with them as well. Thanks so much for tuning in, and we'll speak to you soon.